This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
We're going to stay with cars a little bit.
Yeah,
EVs,
let's stay
right?
with cars.
Yeah.
It does already seem like a theme of 2024 is the way that the American car buyer has cooled when it comes to electric vehicles. The latest is that Ford said it would reduce the number of workers making its F-150 Lightning truck as demand for EVs continues to weaken. Ford shares bouncing around early in the session on the news, off an earlier loss of 1.5%, now up nearly 2%, though the stock already down 8.4% so far this year. Carol, it comes a bit over a month after Bloomberg reported that Ford would cut production goals for the F-150 EV in half in 2024.
Yeah, it's a big move, right? What happened? Less than 2 years ago, Ford CEO Jim Farley saw the electric F-150 Lightning as a bet that the company was kind of all in terms of its way forward. Ford's biggest move, in fact, since Henry Ford ditched the aging Model T to make way for something new. Our go-to when it comes to things on Ford and really what's going on in the EV space is our own Keith Naughton.
Yeah, he actually wrote a cover story for Bloomberg Businessweek back in April of 2022 that featured the Ford CEO and the company's massive make-or-break bet on EVs. And since then and before then, he's been chronicling the ups and more recently the downs of Ford's transition to EVs. He joins us on Zoom from Detroit. So Keith, it's good to have you back with us. It's always good to chat EVs with you and what's going on in the environment. I went back and read that April 22 cover story of Jim Farley and the debut of the F-150 Lightning. Give us sort of the postmortem here. Is it too early to say that this was a bet that's gone wrong?
It's probably too early to go that far, Tim, but certainly it has not worked out the way Ford imagined it would. And, one of the comments from Jim Farley back around the time of the F-150 Lightning introduction kind of rings ominously now. He said this will be a test of acceptance of electric vehicles in America because, of course, the F-Series truck is America's #1 selling vehicle. So if you can't sell an electric version of that, is America ready for EVs? Well, it turns out they're not as ready as Jim Farley and many others in the auto industry thought they would be a couple of years ago. The EV sales growth rate has really slowed down. Now, EV sales are still growing. We need to be clear about that. They're growing faster than the market. But last year, they grew 47%, and this year, UBS says they'll grow about 11%.
So I know we've gone round and round with you on this, but I'm going to go back there. So Keith, it's just a matter of time or timing, and so maybe the timeline is a little bit longer on the ramp up to EVs, certainly here in the United States. Globally, we're seeing certainly a pickup, but help us out here.
Yeah, it is a much stronger take rate in China and in Europe, but there are some, government incentive reasons for that, particularly in China. If you want to get an EV in Shanghai, your license plate is free. If you want to get an internal combustion engine vehicle, you have to pay $12,000 for that license plate. So China has used a real stick approach to become the world's largest EV market. Here in the United States, consumers are saying prices are still too high. The average price of an EV is still around $60,000, even after all the price cuts. And that the charging network is just not robust enough. People are worried about being left stranded by the side of the road with no charger nearby.
Yeah, and certainly the cold weather around the country hasn't helped the image or the thought of that, I think, for a lot of people. Keith, what do you think needs to happen for the U.S. to actually consistently sell more EVs and make sure that it is a country that's moving in that direction? Because I think what's most striking about the news that we got earlier today that you reported is that Ford's actually redirecting some of the money that was going to EVs and actually to build more of the new Ford Bronco, which is an internal combustion car.
Yeah, exactly. We are going back to gas-fueled cars at Ford with this announcement today. They are cutting a shift at the electric vehicle plant, and taking some of those workers and moving them over to the Bronco and Ranger pickup truck plant, which are both internal combustion engine vehicles that are selling well. And those are the vehicles that make money for Ford. So they need them to sell well so they can finance this EV future. It's this very delicate balance. I think Americans have to be convinced that they don't give up anything to get an EV, but instead they gain something. And right now they see, convenience being sacrificed because it takes longer to charge than it does to gas up a car, and it's just simply more expensive.
Hey, I'm just thinking about how hard this has got to be for Jim Farley on this whole idea of balancing production to meet customer demand and still being committed to a future with EVs, but also as a publicly held company, knowing that every quarter they're going to have to answer to their investors. So it's not going to be easy, is it?
No, and they are losing billions on EVs. In fact, last year, they initially said they expected to lose $3 billion on EVs in 2023. And then they had to increase that to $4.5 billion, $4.5 billion. And now they're maybe even worse. So it's a very difficult business case to make, particularly when the uptake is going slower than you expected, because they counted on volume to really kind of turn it around.
Keith, is this a Ford problem, or is it a systematic wide problem? Like, is it affecting the other companies the same way that it's affecting Ford?
The EV slowdown is affecting everybody. GM has delayed the launches of a couple of EVs. Everybody is sort of scaling back their EV spending. Even Elon Musk is cutting the prices of his best sellers to try and stimulate sales, but is still seeing market share losses and margins getting compressed. So there is an overall slowdown in the U.S. EV market.
But is it hitting Ford harder?
Yeah, and so to the Ford point, so Ford got out there early, particularly with the Lightning, by essentially converting, the gas-fueled F-150 into an electric vehicle. They have a second generation of EVs coming that will be ground up, that were designed from the start as electric vehicles. And they promise those will be just really advanced, lots of digital features that consumers will love. Those don't come till 2025 or 2026. And they were just downgraded this week by UBS, who said that the EV payoff is going to take longer than expected for Ford.
You know what I don't understand? We're coming off of COP28, right? That happened in Dubai. And the big agreement that everybody pointed to, this transition away from fossil fuels as part of a global stock take, if you will. It was the first time that COP mentioned this. So it's out there, and I think about the regulatory push also. So it means we're going to get there again, or I don't know. I try to kind of make sense of it, if you will, Keith, that we've got stuff like that
I think
going
it means,
on. Yeah.
I think what you're seeing is that it'll just take longer to get there because, government regulation or guidance can only go so far. It becomes a pocketbook issue for consumers. They're just not going to shell out $60,000 for an electric vehicle when an average, internal combustion engine vehicle costs $13,000 less.
Hey, before we go, 30 seconds, who are buying EVs here in the United States? What's the demographic? And just quickly, if you can, sorry.
Yeah, it is primarily men, wealthy. They're buying it as an extra car for their household rather than as their primary daily driver.
All right. Good stuff. As always. Listen, thank you so much. Always appreciate it. Have a great and safe weekend. Bloomberg News auto reporter Keith Naughton joining us there. And again, Ford shares, if we take a look, they're higher on the day on this news, up about 1.5%, off their earlier highs of 2%, but also off their lows of the day when they were down about 1.5%.
And if you want some good weekend reading and maybe you missed it the first time around, go check out Keith's cover story about Jim Farley and Ford's bet on EVs back in April of 2022. It's on the Bloomberg terminal. And it's at Bloomberg.com/businessweek.
Yeah, that cover story was a great one.
Yeah.
Yeah, I think it's important. And I love kind of also hearing from Keith that, longer term, the commitment is still there and that's the direction. It's just, again, maybe taking a little bit longer, especially here in the United States.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
To make what life's about, yeah.
All right. Well, life is about a lot of things when it comes to investing, and it often means transitioning. We talked about that kind of with the EV space. There's a lot going on. There's a term that I came across in kind of getting ready for this segment, transition finance, which is shaping up to be one of the new year's most important subjects for anyone professing to care about the climate crisis, Tim.
So it's distinct from green finance, which generally targets so-called climate solutions like wind farms or battery plants. Instead, it's loosely defined as investments mainly in industries and infrastructure that help drive efforts to achieve a net zero economy.
Exactly. So we've discussed about a lot of these things, and we've also talked about kind of the rethink among investors when it comes to ESG investing specifically. A decline in the U.S. has resulted in an overall slide in the global market for ESG investing. A recent assessment by the Global Sustainable Investment Alliance, they provide updates on the size of the market every 2 years. Well, the 2022 review, folks, published in late November, shows that investors had 30.3 trillion in sustainable assets. That's down from 35.3 trillion in 2020. And in US, you really saw a big drop. Sustainable assets falling to 8.4 trillion last year from just over 17 trillion 2 years earlier, according to that report. A lot of it was attributed to a change in methodology used to calculate the numbers. But we are seeing investors kind of rethink and retrench a little bit.
It's not the first time we're hearing this either.
No.
So here to talk emerging trends in the ESG space, we got Maureen O'Brien, SVP of Corporate Governance at Siegel Macro Advisors, U.S.-based investment consultancies with combined advisory assets exceeding $500 billion. She joins us on Zoom. Siegel Macro Advisors, I should tell you. I read that incorrectly. I'm sorry, Maureen. So tell us a little bit about the study and the findings here.
Yeah, thanks for having me on. So every year, Siegel Macro Advisors surveys our top investment managers on emerging ESG trends. This is what they're doing in-house, how they're tracking emissions, how they're looking at DEI, whether they're continuing to have a hybrid model. So we ask them a variety of questions and then put those results together in a summary report that we put up on our website.
All right. So what were some of the summary, and why do you think it's important to kind of remind people of what's going on?
So on climate, as you guys were just talking about, we are seeing some movement there of investment managers who are tracking their emissions internally and then also tracking emissions for clients. So what that's telling us is that more retirement funds, benefit funds are seeking to establish their carbon footprint and then see how they can reduce that footprint over time. So we're seeing more than a majority of investment managers start to track those emissions and look at net zero targets, which is a change that we're seeing incremental progress on. Another big finding in the survey this year is on DEI. During the Black Lives Matter movement and the follow-up to that, we saw a lot of investment managers making announcements about hiring and promoting women and people of color. And unfortunately, the survey results this year showed that those gains have essentially disappeared. It looks like women have gone down as an overall percentage of the workforce and a percentage of the C-suite. And particularly Black employees have seen big reductions in the overall workforce, and a 50% decrease of Black representation in the C-suite is what the survey found this year.
Hey, Maureen, when Carol and I talk about this, we always go back to this one idea, and it's actually makes sense because it's earnings season. When we hear from companies and we hear what moves a company's stock during earnings, it's top line, it's bottom line, and it's what the outlook is. They're not talking about ESG. That doesn't move the stock.
It never comes up.
It never comes up in the context of it actually being something that they're talking about with relation to the company's stock price or the company's business. I don't want to say never because it has before, but mainly that's what we're hearing. Does that change? Do we ever start to see some sort of metric that actually moves a stock relating to what you're talking about?
Part of the difficulty when we talk about ESG is that it's not one thing. So there's a lot of discussion about ESG in the regulatory environment right now and among investors, but essentially it's being talked about as sort of one concept, and it's really many things. So aspects like worker rights and climate change are gonna affect how successful companies are. I don't think it's a clear line between there is a good DEI program and then the next day the company is shooting the lights out compared to the competition. these are inputs and factors that do have an impact over time, but they are not overnight market movers.
I guess, too, it's just, it all seemed to make so much sense early on. And I think, the original idea of ESG was kind of the vulnerability, of companies, publicly held companies, when it came to ESG metrics, right? What it meant for them. I don't know whether the narrative changed, and it was like kind of this doing good thing. And I'm not saying that they can't be both. But having said that, all the money that has gone into ESG investing, Maureen, what can we turn to say, okay, it's really improved things? Because you just talked about that things haven't in some ways gotten better.
Mm-hmm. Yeah. I mean, first of all, we used to not know, right? We just didn't have a lot of data. I mean, the only required ESG information out there was how many employees you have. So not even a breakdown of demographics, for example. But we didn't have any data around carbon emissions. We still don't have a lot of data around that. Workplace issues, how companies are doing with their turnover rate. Companies will often say employees are their most valuable asset, but there was no required measurement of that asset apart from where the operations are and how many people work there. So a large part of ESG has just been trying to get that data available. You've seen a huge increase in the number of companies that have sustainability reports, that are joining up for organizations like CDP, the Climate Disclosure Project, and other initiatives where they're voluntarily providing this data, but it's still not at the point where the data is as easily comparable as it is with financial data. So that's a big part of the problem. But that is changing. The SEC has a pending climate rule that is looking like it will require lots of information on climate. And so once companies begin reporting on that, it's much easier to do that evaluation of who are the winners and losers in this climate transition.
And we want to share from our audience, though, some of the stats I think that you talked about earlier, and reminding us how things haven't changed. If you look at the workforce, it's still predominantly white. So it's 63% of the individuals who are working are white individuals. If you look at race, right? Again, white, predominantly about 79%. If you look at...
That's in the C-suite. So that's
the C-suite, forgive me.
So that's, the people making the decisions. It's 3% black, 79% white.
Right, exactly. Overwhelmingly. And then again, gender, which you talked about earlier, again, C-suite gender composition. You're talking about only 26% are women. I've been doing this a long time and nothing's changed. Just got 10 seconds here. What do you hope people take away from this conversation? Please, if you could be quick.
Yes, it's important to set goals, track progress, and be public about the journey. Without intentionality, the historical trends do not reverse themselves.
All right. And there is something to having the importance of data so that you can actually understand what's going on.
We're talking about it now.
Yeah. Well, we've talked for a long time, but to see the numbers, the concrete numbers. Maureen, thank you so much. Maureen O'Brien, Senior Vice President of Corporate Governance at Siegel Marco Advisors from Chicago. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, a billionaire couple is giving $100 million to Atlanta's Spelman College, which the women's school says is the largest ever single donation to a historically black college or university. The donation announced yesterday by Rhonda Stryker and her husband, William Johnston. She is the billionaire granddaughter of the founder of medical device maker Stryker Corporation. He is the chairman of money management firm Greenleaf Trust. They live in Michigan.
Spelman said it would use $75 million to endow scholarships. The rest of the money will be used for other purposes, including developing an academic focus on public policy and democracy and improving student housing, a sore point in recent years among Spelman students.
We are so delighted to have with us to talk about this historic gift in what it is a historic year for Spelman. Dr. Helene Gale, she's president of Spelman College. She is on Zoom from Atlanta, and also with us, delighted to have here Bloomberg News higher education finance reporter Janet Lauren in our Bloomberg Interactive Brokers studio. Dr. Gale, congratulations. Thank you for giving us some time here. Can you talk to us a little bit about how this gift came up? How did Rhonda Stryker come to be a trustee at Spelman? And what's it like to receive the news of a gift of this magnitude?
Well, thank you, and thanks for having me on. Well, Rhonda Stryker is one of our longest-serving trustees. She was brought on by one of my predecessors over 20 years ago. And over the years, she and her husband have continued to contribute to Spelman and, have been incredibly generous donors. But this is clearly the largest single gift that they have ever given. And as you said in the run up to this, it's the largest single gift that Spelman has ever received and the largest gift to any HBCU. So it's pretty exciting and, truly a transformational gift that I think can make such a huge difference for Spelman, not only now, but far into the future.
So thank you again for coming. So tell us, how does this donation impact your endowment's longevity, especially when it comes to scholarships?
So, we plan to use 75% of it for endowing scholarships. We will obviously put that money to work immediately, and in a year or so there will be returns that we can use to start increasing our scholarships already. But as you know, endowments really what you can do with an endowment is to think about future generations. And so, we look at this as the way that we can secure the future for bright, talented young women who want to get a Spelman education, but oftentimes are not able to because of financial barriers. So, we think this is going to make a difference for our students today, but also for the students of tomorrow.
Well, and I was looking at your most recent value of June 2022. It was less than $500 million. And then this gives you a huge amount of money more to invest. Can you talk about what that means for having, having that in the fund and to be able to build on it and to be able to do things like help students graduate and boost those rates and, help them return the next semester if there's trouble?
Yeah, no, totally. That's exactly what, we hope to be able to do. As you stated, we have an endowment that's just under $500 million. That is large for for many of our HBCU colleagues. But, when we compare ourselves to similar schools, similar size type and similar types of populations, our endowment trails many of our peer institutions. And so, we think that this, which is a huge increase in our endowment, will be able to provide scholarships for students. As we have a high need population. We've got brilliant students, grade point averages that range 3.9 and above. But we also have a high need population. 40% of our students are Pell eligible. About 80% of our students get some sort of need-based financial aid. So, we want to be able to bridge that gap between the talent that we see walking through the door and the, real gap in financial resources. When you can take this incredible talent pool and match it with the resources that allow them to have this kind of life-changing education, I think we can make a huge contribution through this gift and, hopefully many more. We hope that this is the kind of gift that will inspire others to invest not only in Spelman, but other HBCUs.
So, I want to talk a little bit more about the cost of higher education, because we got some news earlier today that President Biden is continuing with his efforts to try to reduce the debt load that Americans have. Whether or not that is successful remains to be seen. But the cost of higher education at your school is $46,000 a year for a student living on campus. I got to tell you, that's a relative bargain in this day and age. We were talking with a colleague recently who about another school, not an Ivy League school, a small liberal arts college, over $90,000 a year. Why does the cost of higher education continue to be so high, Dr. Gale?
Well, every school is different. We've tried very hard to keep our costs as low as possible. In fact, we reset our tuition and fees a couple of years ago to be able to try to make our education as affordable as possible. But, costs continue to rise. Employment costs continue to rise. We have to be able to attract the kind of high caliber faculty that attracts the student population that comes to Spelman. We've got to make sure that we pay our staff and administrative support the kinds of resources. And so, a lot of the cost of a college or university are the personnel costs that continue to go up. But we also know that construction costs, other supply costs have all continued to go up. So, we try as hard as we can to manage those costs, to not have to increase tuition and fees, but we also have to be competitive in today's market.
But does it feel a little crazy when it's almost $100,000? I'm just, you understand this world.
I think we've got to work on both sides. We have to work on making education more and more affordable, but we also have to look at how are we making sure that students do have the kind of resources, access to scholarships, access to low-cost loans to be able to afford education. So we've got to work on both ends, and we've got work to do.
Right.
So I read a lot about fundraising, and I would love to hear, how does a gift like this come about? You must have been working on it for years and years. If you could take us through that, and also what's it like to get the nod? Yes, we're giving you $100 million.
Well, as I mentioned, Rhonda Stryker has been a long-serving board member, and she has seen the transformative nature of a Spelman education. We have young women who walk through the door, without, as young women, and whose lives are transformed by the education that they get here. She has seen the economic value that occurs when a young girl comes in the door, leaves, ready to go out into the workforce. If you look at the statistics, HBCUs like Spelman have punched above their weight for so many years. And I think she has seen that the value of investing can make such a huge difference. And so, gifts come because people believe in your mission. People who have resources, who believe in your mission, have the opportunity to experience why it's so important to invest. So Rhonda Stryker has had the opportunity to see what it means when you can match the talent pool that we have with the kind of resources that can be transformational and change lives. Spelman College has the product of Spelman College is obvious. We could rattle off the names of important leaders in business, right, in policy, in politics, in arts, entertainment, entrepreneurship. And so we know that there's a product that comes from Spelman that changes lives.
Well, thank you so much for finding time for us. Congratulations. We know it's also an important anniversary for you guys and the official naming of the school. So congratulations on that. Dr. Helene Gale, president of Spelman College, and of course, Bloomberg's own Janet Lauren.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Bitcoin this week down nearly 2%. Interesting to see given the risk-on mood that we saw in equities, driving the S&P 500 and NASDAQ 100 and the Dow, Carol, to finish at fresh records. Since that spot Bitcoin ETF, or I should say, since the spot Bitcoin ETFs began trading last week, there are 11 of them, and spiked to more than $48,000 per Bitcoin. We're now seeing Bitcoin trade down quite a bit, at about $41,646 per coin. Okay, so let's get into it with Stephen McClurg, Chief Investment Officer at Valkyrie Investments. We should note Valkyrie is one of the 11 companies with a spot Bitcoin ETF. That ticker is BRRR, Burr. Stephen, good to have you back with us. first full week of trading for spot Bitcoin ETFs. We saw Bitcoin move lower for the week. Just give us your take now that we've had a full week of this.
Yeah, absolutely. And thanks for having me back. Well, first of all, what's happening in Bitcoin is what we expected. We do expect Bitcoin to be pretty range bound between about 42 and 48 through probably closer to March or April. A lot of the risk on that we're seeing in the markets is due to an expectation that the Fed will probably start lowering rates in May or June. But with the Bitcoin spot ETF coming out, there's been a lot of outflows actually out of the Grayscale ETF.
I saw that. Yeah. Why is that? It's sort of a buy the news, buy the rumor, sell the news. I don't even know the saying.
Yeah. So I previously was an investor in that particular trust as well, and really what's happening is people were locked in and couldn't get redemptions out when the fund was trading at a pretty big discount. And now that discount is narrowed back to zero, people are able to begin to withdraw again, sell out of it at market. So we've seen about $5 billion in outflows so far just in that ETF, which
Right.
we did expect to happen. But we are seeing positive inflows into ours and all the other ones.
Well, talk to us about that, because I'm curious if those outflows out of Grayscale are finding their way to you. Give us an idea, size and scope, in terms of the flows that you guys, Stephen, are seeing into your spot Bitcoin ETF specifically.
Yeah, we're seeing a very steady stream of flows in ever since the first day of trading. We've probably witnessed anywhere between $20 and $30 million a day for the most part, a few exceptions. But it's a very, very constant stream coming in. I think some of those flows out of Grayscale is coming to us. But I think a lot of it's new money, people that want access to an ETF and now have one and have it in their brokerage account. It's easy to maintain. So that's where we're probably seeing more of our flows is new money as opposed to flows out of Grayscale.
Any money coming out of your fund, though, in that first
we haven't
week?
seen any.
Yeah,
we haven't really seen anything coming out of our funds. We also have a mining fund as well as a mixed Bitcoin and ETH futures fund. And we've actually seen positive inflows into those as well, particularly the mining fund. A lot of people are looking at that as a way to gain extra beta or, more than a 1x beta to Bitcoin.
Do you know if any of that money going into BRRR is coming from advisors?
It is. And a lot of the financial advisors that we speak to, they have been waiting for a Bitcoin spot ETF. Most of them are independent. A lot of the advisors that work in the big wires, it's going to be a little bit of time before they start coming in. The firms like UBS and Morgan Stanley, their committees have to go through due diligence on the managers, on the product. Usually takes somewhat of a track record, anywhere between 1 and 3 years. So that's when we're seeing a lot of the big flows. But the independent RIAs are definitely coming in. And some of them that don't feel like they quite understand Bitcoin yet are making their moves into some of the Bitcoin ecosystem funds, as well as the Bitcoin mining fund, which, again, we've seen a lot of positive inflows into that, just as much as we've seen into Bitcoin spot.
So help me understand, or how you see it, right? One would assume Bitcoin, I know that some have said it's a safe haven like gold. Some would say no, it's when the risk trade is on. We've seen it kind of go each way. But I'm looking at Bitcoin down about 9.5% since the spot Bitcoin ETF started trading last week. I'm looking at a NASDAQ that's up 3%. I'm looking at an S&P 500 that is up about 1.2% in that same time frame. We've seen, Stephen, the risk trade come back. Is it surprising not to see Bitcoin moving up and the whole group overall?
Yeah, I'm not too terribly surprised, only because of the expected outflows that we were to see in Grayscale. I think once that is washed out a bit, we should start seeing the market move up again. And you also have to keep in mind that in the short run, things aren't always correlated, but in the long run, they are. And in the last 3 months leading up to the Bitcoin spot ETF launches, we did see Bitcoin rise in price quite a bit. So I think the market got a little bit too excited. Now it's waning down or getting back to a level that we think is sustainable. And once these outflows begin going out, I do believe we'll see it again. And on that note, I'll also mention that, Bitcoin acts in response to the way that people treat it. So some people use it as an inflation hedge or as a safe haven. Some use it as a risk-on asset. And depending on the cycle or the mini cycle, we will see Bitcoin react in those various ways. I think the short-term move really is more of a reflection of selling out of one fund. And we should probably see it move more like a risk asset through the rest of the year.
Hey, back to the ETFs. I'm just wondering if you're planning to do a proof of reserves or maybe share your addresses at some point in the future.
Yeah, absolutely. So we actually do post we do post our reserves, and really simply put, we hold everything at Coinbase. So there is a 1-to-1 Bitcoin to what we say is in our fund. Sitting at Coinbase. Now, we probably won't show the address just because that's a security reason,
right?
Or that's a security issue. But we can point back to Coinbase on that.
Hey, can you give us 25 seconds on the next steps and plans? You've been acquired by CoinShares. We're already seeing consolidation in the crypto asset management space. So, what can you share about next steps? And again, just got about 25 seconds.
Oh, absolutely. And this is exactly what we expected in the market when we launched our firm 3 years ago. Once a Bitcoin spot ETF comes to fruition, we will see consolidation. We'll see larger asset managers that want access to this asset class and want expertise. And we're seeing, just like with us, we're seeing consolidation within the space.
All right. It's always fun to watch, that's for sure. Stephen, thanks for taking some time out for us. Stephen McClurg, Chief Investment Officer over at Valkyrie Investments, on Zoom from Nashville, Tennessee. This is Bloomberg Radio, and this is Bloomberg Businessweek. Carol Massar, Tim Stenovec. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, well, it's that time to drive to the close. And before we do that, I want to get to a headline. A redhead crossing the Bloomberg terminal. Apollo Global Management considering making an offer for National Amusements, Inc. That's, of course, the Redstone family company that controls film and TV giant Paramount Global. This by our own team, including Lucas Shaw, Ryan Gould, and Michelle Davis.
Yeah, interesting too, because you're seeing Apollo Global hitting a record in today's trade. So it's been actually moving up in the session. Not that that's necessarily related to this news, but it's up about almost 2% today.
We should note that Apollo is one of a number of investors, both wealthy individuals and professional money managers, that have reached out in recent weeks to BDT and MSD Partners, the investment bank advising the Redstones. That's according to people familiar with the discussions.
All right, so something to track on this Friday. We're tracking a lot on this Friday, including an equity market that is pretty much at its best levels of the session. So we've seen really investors, certainly on the equity side of things, come back. NASDAQ, as we heard from Denise, really the outperformer, up 1.6%. We saw this trade yesterday. So let's get to it. Let's get to our Drive to the Close guest. Back with us is Doug Sioka, CEO and partner at Kavar Capital Partners. They've got over $1 billion in assets under management. He is on Zoom from Leawood, Kansas. Hey, Doug, so nice to see you. I can't remember if we've had a chance to say Happy New Year. It's already been kind of a busy 2024. How are you?
Yes, I'm great. Happy New Year to you guys as well. Thank you for having me on.
Is it cold in Kansas?
No, it's frigid and ridiculously freezing in Kansas. It's 4 degrees right now and dropping.
Where is it colder, Buffalo or Kansas?
Kansas, yeah.
Okay.
It looks for the game on Sunday. So the Chiefs will be up in Buffalo. It looks like 22 and no precipitation. So it's going to feel balmy after the game last weekend when it was minus 27.
It's a big game this weekend. And I got to say, Doug, it's so great that Taylor Swift came along to help out the Chiefs and really get Travis Kelce on track. I bet you're really happy that she came into his life.
I am. I am happy for her. I'm happy for the city. It's been great to have her around town. And he's very visible. She's got a bit of a cloak of protection around her, which is necessary. But she's been seen around town, and it's been a lot of positive buzz in the city, and we love it.
Well, talk about the game. Patrick Mahomes, it's hard not to like this guy, even if he's not your team. Every time he's in a Super Bowl, I love watching. He's just this great little player and just seems to pull it out all the time. But speaking of the Chiefs and the team and their strategy, my understanding is you think investors should take note of what they've been up to as well. Yeah,
I mean, it's a kind of a little corny take on what's happening at Arrowhead Stadium, but our town tends to sort of evoke the character of their sports teams. And I've kind of made a little bit of it's probably a bit of an extension, but the Chiefs have some characteristics that they also share with kind of fundamental portfolio management of the prevailing markets. And right, we've been saying, look, you've got to have good defense, and that's been kind of the heart and soul of the Chiefs team this year. In the bond market, right, in this silly analogy, right, it's offering very stout defense, right? You've got sound portfolio protection, robust income. You've got to have secondarily, kind of like to your point, this Mahomes magic leadership. We need to have some tried and true, probably tech-centric growth stocks, embracing AI, distancing themselves from the competition, and exhibiting incredible agility in a fast-paced industry sector. And thirdly, you've got to have sound diversification, right, in your portfolio, and certainly on the football field. And you've got to be able to score in multiple ways. Expectations are high. Playbook's well worn at this part of the season. So you got to pull out all the stops, and having someone like Andy Reid as our head coach, there's never any lack of creativity in offense. That's for sure.
Doug, do you like football?
I love football.
Okay,
yeah.
I thought so. Okay.
I just wanted to make sure.
Just wanted to make sure. Yeah. Hey, can you connect the Chiefs season at all to the key themes to watch for 2024? Because I know you're watching certain elements here, including geopolitics, what's going on with rates.
Absolutely, Tim. And like everybody, right? Like interest rates are the overriding sort of priority one theme of 2024, as they were in 2023, as they certainly were in 2022. So interest rates, earnings, geopolitics, and domestic politics, sort of cross-pollination there. And then we really feel like in 2024, we're going to see an appreciable increase in M&A activity. So I'm happy to talk about any or all of those, the four-pronged thematic outlook for sure.
Can we go to interest rates? We just talked with our Bloomberg News rates reporter, Michael McKenzie, and this whole idea of, bond traders really very closely watching maybe the treasury curve here in the U.S. getting back to normalization, this whole idea of, no longer an inverted yield curve and those longer durations moving up. But having said that, the path to getting back to normal, the question is, does the longer end of the yield curve go higher or does the shorter end go lower? And I am curious what your take is on it, because it means different things.
Yeah, so throughout last year, Carol, we saw what was called a bear steepening, right? And we saw as the short end came up and the long end, I should say that the long end barely budged. In that sort of unwound kind of going into to midsummer, we saw the pullback in equity markets when the expectation was, hey, the Fed may not be done, right? There was a lot of mixed messaging coming from some of the Fed governors on their speaking tours. We've actually now seen some more of a bull steepening that's taken place. Well, the expectation in the market, and it's begun to dissipate, right, from definitely putting in 6 cuts next year to maybe more like 4.5 or 5, if that's possible. So you've seen the expectation that the Fed might not be cutting as much as had been anticipated. So the 2-year has really been pegged, and all the action has been on the longer end. Now, we did see some normalization, even on 2s and 30s earlier this week, right, where we finally saw that was kind of a refreshing deal. We've gone from 98 basis points of steepness to 2s, 10s. Now we're just at like 23. So we're seeing the right kind of steepening that's taking place. And why is that, right? Because everyone knows the Fed is done, right? How quickly the Fed cuts is really open for debate. I saw an interesting interview this morning with Austin Goolsbee. What he was saying, which I thought was really interesting, is the investors are hinging on the words of the Fed, and they need to be hinging on the data. But at the same time, we will still raise rates if we feel like the data is inconsistent with the general trajectory of inflation. So that was a little bit of mismessaging as well. But what the market is trying to do is ascertain 2.5 to 4% GDP growth. Boy, that's pretty good.
Yeah.
A labor market that's finally coming into balance. Boy, that's pretty good. Certain industries in the stock market, they're just starting to hit kind of a sweet spot of the upswing of their profit cycle. So you can see the soft landing scenario with rate normalization without seeing like a widening of the normalization, but just getting to where we have opportunities to pick up term premium. That's going to be really reassuring in the face of declining inflation.
Well, certainly something to think about as we head into the weekend and get ready to watch a lot of football. That's what I'm going to say. Hey, listen, be well. Great to check in with you. Doug Sioka, CEO and partner at Kavar Capital Partners. As we mentioned earlier, they've got over $1 billion in assets under management. He's joining us on Zoom from Leawood, Kansas, where it's getting chilly.
Doug, are you going to go to the game?
No, the game's in Buffalo.
I know, but you could still go.
Yeah. Could still go.
Okay.
No, I will be here. Yeah.
The Kavar jet might take you?
Oh, now you're talking. Once we get that, we'll have to fire it up.
Doug, good luck this weekend. Appreciate you, as always,
you,
joining
guys.
us. Good luck.
Happy New Year.
Thank you.
You too.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.